Welcome to TheoTrade. This is Don Kaufman. March 7th, 2022. We're minutes after the cash close here on this Monday afternoon. S&P is getting absolutely crushed, down over 3%. Nasdaq down over 4%. The VIX once again exploding to the tune of about 14% higher. Is this marketplace really starting to kind of break apart? We're going to look at that. We're also going to look at some of the commodity pricing, which is driving many of the moves here inside of the S&Ps. Let's get to work right off the bat. We actually have breached through a fairly critical level right into today's close. That particular level, and again, it is critical that we hang on to this, the 4211 inside of the S&Ps. It's something I mentioned numerous times on the weekend update. That is first and foremost. Losing this particular level, markets just get downright wicked, ultimately to the downside. And if you take a quick glance at a 30-day 1 hour, and I've used this particular chart extensively. Listen, I am not by any stretch of the imagination a market technician. You're not going to see any MACDs, and many Fibonacci's, no Bollinger Bands. You have to realize at this point in time, you've got nothing, okay, but a geopolitical hotbed of risk of a marketplace. What we are looking at inside of this chart happens to be this kind of incredible volatility box that has formed, and we are effectively outside of it. Why this matters and why I'm so intense about this volatility box. Huge amounts, okay, of open interest in the marketplace accumulate at these particular levels. The longer you sit at one level, if you will, this kind of hits like a little bit of a crescendo. Now, when you're inside of one of these volatility boxes, okay, and we start to breach, what that basically does is it just accumulates massive amounts of negative gamma risk. And what it really means when I talk about like, oh, it's negative gamma risk, trading firms have to hedge in the dynamic of the marketplace. In effect, what are we saying? The more we sell, the more they're going to have to sell into it. And because we have been trading, okay, in the exact same range, and again, accumulating open interest, the amount of risk that we're actually seeing unfold right now, again, it is dramatic, it is huge, and you can feel it inside of the marketplace. By feeling it in the marketplace, just take a look at the at today's closing bell, where ultimately, okay, the S&P futures traded north of 60,000 contracts, and that's something you'll see quite often. Something you won't necessarily see, okay, too often is the fact that we're doing in a neighborhood of like 1.8 million contracts. But one other aspect to be really, I guess it kind of unfolds in this market. The volume that you're seeing in these last 2 down days, it just doesn't look like capitulation in a marketplace. You can see massive hedging activity on an intraday basis. I mean, that's these huge bursts, if you will, into the close. And again, you can actually see volume coming up, a wild amount of volume coming up as we actually drew into the close, which again, all I'm trying to point out is that the gamma risk, all right, that kind of unfolded in a substantial way right as we crossed through that 4211. It just got wild, got extreme, volume picked up. We lost even the 4,200 inside of the marketplace. And ultimately, we've actually ended this trading session just into the lower edge of the expected move already in the SPX. I mean, we're home the entire week. Okay, movement effectively packed into the last 6.5 hours of trade. And what you have to have a lot of respect for is, the market sold off overnight, rallied back up. I mean, we opened the day massively unchanged and, well, legitimately sold off at this point over 137 handles. So kind of trying to answer that question is, is this it? Is this marketplace beginning to break apart? Well, evidently we are. But to further that, I don't think that it's appropriate just to look at the S&Ps. The S&Ps at this point are pretty much reactionary. You have a lot going on outside of the overall like S&Ps. First and foremost, okay, the advanced decline line here, it's a little bit disconcerting because we're not in this like hideous full-blown correlation state. I mean, there's stocks like Costco today that even finished the day slightly higher. Okay, Caterpillar, which actually had, decent highs today and actually reverted back down, but again, still positive. Obviously, the energy sector is still positive in the day. And frankly speaking, that's not something, okay, that looks like outright capitulation. So the S&Ps, to say that they couldn't be, bounce from here, of course they can bounce. As I said, we're a geopolitical hotbed of risk, right? One little news announcement, S&Ps are going to soar by 100, 150 points, okay? But the issue and what really is at issue right now is just completely coming apart at the seams based on what you're seeing inside of the marketplace. The volatility is right for it. I mean, we're already rushing into the dollar. I mean, the dollar right now, okay, is soaring. Why? It's duck and cover. Where else in the world are you going to go? I mean, legitimately, where are you going to go? What's interesting is the bonds. You're like, well, shouldn't the bonds be rallying? They should be duck and cover. There's so much discussion right now of inflation that the bonds are almost like locking up. Okay, they're seized up. Does anybody really want to buy bonds when we could be headed into one of the largest CPI prints, okay, in history? And CPI is coming out. Yes, it is. CPI is coming to a theater near you on Thursday. Not a lovely week ahead of us. I mean, ultimately, there's just, real tough to find reasons to want to buy. Now, as I said, commodities are playing a pretty significant role. We'd be remiss, of course, not to mention oil at $120 a barrel, or we can even bring up, Brent in this particular case. But oil, well off some of the overnight lows of 130, but still closing ultimately at 120. Let's go to some markets, though, that you don't necessarily look at on a day-to-day basis. Okay, one critical one, unequivocally, is side of wheat. All right, wheat pretty much comes from Eastern Europe. Okay, in mass quantity. That's where it's from. What you're looking at inside of the chart, when you go to a 1 day, 1 minute, that's the chart, people. These are limit up events. Effectively, there's no trade. When I bring up the 30-day 1 hour, it really speaks volumes, if you will, of some of the price action that we've seen lately in a few of the commodity products. Wheat, okay, unequivocally hitting limit up days, okay, in umpteen consecutive trading sessions. What other commodities really beg to be looked at? I was talking about this a moment ago, but if you even take a look at Brent, a lot of people don't necessarily look at Brent crude hitting 137, reverting back down, but still at about 123 a barrel. Everywhere you go, pretty much every commodity, including, of course, gold. The irony is that gold looks a lot right now like the dollar. And that's, you see commodities rallying and the dollar rallying with it. Again, it doesn't bode well. And that's what I was talking about with the markets starting to show some real significant cracks. But before I go any further, okay, I want to revert back to the SPX for just a moment. Again, reiterate, we are right, okay, against a major breach of an expected move. And what's chaotic about this particular, breach of expected move is that the entire week, and I'll remind each and every one of you here, if we come over here to Switch Gadget, and we're going to actually cruise over to the scratch pad, remind you, okay, that the entire week we were supposed to move, again, just about where we did today. Today we did about 127 points inside of the SPX. The full week was expecting about a 145 point move, but lo and behold, the S&Ps, they pretty much did in fact make that full move. But here's the crazy part. It's not, okay, the fact that we are supposed to move 145 points. When you open up this Friday's expiration, okay, we're now at $140 expected move. So you say, well, who cares, man? You were at 145, now you're at 140. Yes, but we've actually passed through an entire trading session. Okay, higher volatility is substantiating even more movement to this marketplace. And you pretty much have to just read through what that ultimately says. It says, get ready to rumble. I mean, this movement, okay, is not going away anytime soon. What concerns me is going into an evening like this, we've seen a major breach, and a 3% move in the marketplace is unequivocally what we would term statistically significant. So you have this 3% move. This is an evening that you might want to be concerned. This is an evening where all of a sudden in the middle of the night, you could see, okay, massive breaks inside of the marketplace. I will also remind each and every one of you, and this is not a wonderful topic to have to discuss in an evening video. Nevertheless, okay, it is appropriate at this point in time. We now have a changed limit down event, okay, of approximately 7%. It would be a 7% move overnight that would actually lock the market down. What am I telling you? I'm telling you, if we were to have one of these precipitous slides in the middle of the night, we could move down as much as 7% before they'll lock them up. They actually did, okay, more recently in recent years, change that rule that now we have limit down ultimately at 7% of overnight trade. Nevertheless, does that imply that we're going to head down? No. But you have to be on your game and understand what some of the rules and regulations of this marketplace happen to be. There's no question that volatility has us primed for a wild, wild move. I mean, we're just shy and closing just shy, okay, of a 37 VIX. You have a wild kind of reaction here of almost a 39 VIX, but that 39 VIX, let me remind you guys, that was, hit when the marketplace, okay, was literally 100 points lower than it presently is. Okay, so we are up there and we've been propagating higher and higher volatility. If you take a look at the volatility futures, okay, and to be effective with vol futures, you really want to go 44 days out. You are in a massive, okay, backwardation. Everywhere you look on this screen, right, the conditions are just, ideal for a major break in markets. It doesn't mean that that is going to be the way that this is going to play out, right? But anytime the conditions are just idealistic, I would be remiss not to mention that in one of these evening videos. I'd be remiss not to mention what a limit down event effectively happens to be. You go home on a night like this, and I'm telling you right now, take a good look at some of your delta. You better be really comfortable with whatever risk that you happen to have on, okay, at that moment in time. You can see like my TheoTrade portfolio, people, I'm beta weighted to the spiders. I'm exhibiting, okay, less than 100 deltas, okay. Spread tracker, I've got less than 10 negative deltas in here, okay. The entire portfolio, just to kind of substantiate my overall risk, I'm short about 1,300s. Again, that's negative about 1,300 SPY deltas. If I actually went in here and added in, another portfolio, I can aggregate it all together. Okay. So this portfolio is negative 1,300, add about another, negative 500. We're home. So I'm sitting in this particular account or accounts in this case with just shy of about 1,800 negative SPY deltas. Okay, not dissimilar over inside of my Tastyworks accounts, but the amount of theta we're collecting here, that's, okay, where you want to be in this particular marketplace. Again, I cannot reiterate this enough. Wrap your deltas tight. This week, it's just going to be a downright wild ride. Levels at this point, forget them. Let's not even talk, okay, anymore about, breaching 4,100. The assumption is we're going for it. Right? You have to have the assumption right now that we're not only going through 4,100, but we're going to cruise right down to 4,000. You really have to consider some horrific, okay, and horrendous scenarios in the present market condition. And I'm going to leave you with precisely why. Let's start with Apple. This is something that I've brought up very, very recently on some of these evening and weekend videos. Look at Apple, okay? Relatively unscathed. It doesn't matter what you think about a percentage basis. It's year to date, it's down about 12%. What I want you to do with a handful of underlyings, Okay? Do me a favor, pull up a 5-year. Why? When in the last 5 years, okay, have we actually faced such significant, okay, risk? Obviously, people are going to point to, well, the COVID crash was a flash in the pan. Take a look, though, over the last 5 years and behold, okay, the risk that you're seeing to even a product like Apple at this point in time, okay, has been nominal. Granted, you could look at something like Facebook. That, people, okay, is evidence of real sell-side activity. But then you bring up some of the other monsters of tech, a Google, relatively unscathed, took over a 4% hit today. Okay? What else should we bring up? Microsoft took almost another 4% hit on the day, relatively unscathed. You have to realize that in many of these products, and again, everybody's going to mention March of 2020, in many of these products, we're not back, okay, to where we were, but just a few months ago. So to say that this marketplace is in an oversold condition, I would agree, until you open up a 5-year chart and recognize that oversold in something like Microsoft to be, relinquish us down to maybe 200. Okay, take a look around this marketplace. I think you'll see the exact same thing. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.